Two-day winning streak on the S&P is about to become 3 at the opening bell. Equity futures right now positive by 0.9% on the S&P. On the Nasdaq 100 up by more than 1 full percentage point. Inflation data coming in a lot cooler than expected, almost across the board. Given that, stocks up, yields down. There's your opening bell. Switch up the board. Get to the bond market. Yields look like this, down 7 basis points. Your 10-year right now, 3.90. Your 2-year, let's get to the front end of the curve. Your 2-year yield has been on quite a journey. Pre-SVB through 5.08% briefly, then dropping to as low as 3.55 back in March. Then last week back through 5.1%, and this morning we're down 12 to 13 basis points. Let's call it 4.75 on a 2-year. What a trip. Given that trip, yields down, dollar weaker for a 5th consecutive session. Euro dollar 110.84. That's the high of the session right there, right now. The high of the year, 110.95, back in March, April time when the euro was showing some real strength relative to where it has been. Think about that. The trip we've been on over the last 3 months. Pre-SVB, then post-SVB, then all the way back again. Crude right now, up by 1.2%, $75 and about 73 cents. For the broader equity market, almost 1 minute into the session. Let's call it 1 minute into the session. The Nasdaq up by more than 1%. The S&P 500 up by 0.8%. One stock to watch at the open, NVIDIA. The FT reporting that ARM is in talks with the chip maker to anchor its IPO. NVIDIA seeking to invest at a valuation worth $35 to $40 billion, citing unidentified people briefed on the talks. Abby has more. Hey, Abby.
Hey, John, and we have so much going on this morning. That's just one of 3 reasons that we have the shares of NVIDIA popping. But yes, this is one of the big reasons. The FT reporting exactly what you said, that NVIDIA is in talks to be one of the anchor companies to that chip designer ARM's IPO, of course, a SoftBank company. And last year, there had been the possibility that NVIDIA was going to buy ARM outright, but because that didn't happen, SoftBank is planning this big IPO that NVIDIA could benefit from. The second reason, of course, that NVIDIA is higher, that cooler CPI report for the month of June, sending yields down, helping out big tech. And then the third reason, John, this is really pretty incredible. Recursion, which is a microcap biotech company, it right now is up 106%. They have now today received a $50 million investment from NVIDIA to accelerate Recursion's development of its AI foundation models for biology and chemistry. And on one glance, you might think, well, this is just a smaller stock, but it's actually the 5th most traded stock in the pre-market with more action than Amazon, Meta, or Microsoft. So Recursion now on this AI investment from NVIDIA, it's one to watch.
That's quite a move, Abby. Thanks for that. The update there from Abigail Doolittle. Let's stay on tech. Microsoft's $69 billion acquisition of Activision getting back on track. The FTC denying an injunction to delay the deal by July 18th. Microsoft President Brad Smith writing this. Our focus now turns back to the UK. We have agreed with the CMA that staying in litigation would be in the public interest. Alex Webb has more. Hey, Alex.
Yeah, it's a big day for Microsoft and Activision Blizzard. Microsoft had been trying to pull this deal through. It was very much seen at the time as an effort to boost its efforts in the metaverse. Of course, the conversation has moved on from the metaverse since then. But both of these cases in the US and the UK focus on Call of Duty, but in slightly different respects. Critics have said that Microsoft might pull Call of Duty from other platforms, such as Sony's PlayStation. Microsoft made the case that if it did pull Call of Duty from the PlayStation, the economics of the acquisition simply wouldn't make sense because it does make a lot of money selling Call of Duty to those consoles. In the UK, it's really about cloud gaming. There's been a huge push towards this. Again, Call of Duty in that space. But there had been question marks about whether the CMA, that's the UK regulator, had done enough, had prepared well enough legally. So it looks as though Microsoft's getting a second bite at the apple, and it could be that they reach a settlement, though nothing is guaranteed.
Microsoft up by 1.3%. Alex Webb there on the story. If you are just tuning in, welcome. About 3 or 4 minutes into the session, we are positive here by 0.9%. Inflation data at about an hour ago coming in softer than anticipated. That's driving a bid into bonds, so bonds rallying, price up, yields lower. That means the dollar's weaker as well against the euro, which it's been looking stronger over the last few sessions. I want to turn to the retailers. Kim Kardashian may be buying back the minority stake of her beauty company she sold to Coty. The Wall Street Journal reporting this. The sale price hasn't been determined and talks could still break down before a final deal is reached. Katie Greifeld has this story. Hey, Katie.
Hey, John. Yeah, Coty shares currently up about 1% or so after that report from the Wall Street Journal that Kim Kardashian looking to buy back that minority stake in Skin by Kim. John, that is her skincare brand. It was previously known as KKW Holdings. For her initials, of course, Kim Kardashian West. Now, originally, Coty agreed to buy that 20% stake for $200 million all the way back in June 2020. And Jefferies, which has a buy rating on the stock, says that while the value of the brand is likely lower now, in part due to the suspension of that KKW branding, you're seeing Coty shares rise a little bit today because it could help in their deleveraging efforts. But Coty is actually crushing it year to date, John. Currently, the stock is up about 50% year to date, basically a tech stock. And if you rewind back to June 2020, it's actually up about 150%.
Katie, on the latest, Coty right now up by 1.3%. Following that story very closely, of course. Let's stick with the retailers. Loop Capital upgrading TJX stores to buy with a $95 price target right in this. Recent store checks gave us confidence to increase sales and earnings estimates. We see off-price retailers taking market share this year, with July typically a clearance-focused month. That's stock, at the moment at least, up by 1.6%. One more to watch, Disney. Bloomberg learning the company is weighing options for its television business in India, including either an outright sale or setting up a joint venture with partners. Ed Ludlow joins us now on the West Coast. Hey, Ed.
Yeah, good morning, Jonathan, from Sun Valley. Bob Iger's here, but he doesn't want to talk about the reporting around the India unit Hotstar Disney Star platform. Remember, they lost the rights to show cricket, which is just a massive property in India in particular, to a JV or a platform operated in partnership with Paramount. You have to put this into context. The Disney Hotstar or Disney Star or television units in India generated $1.7 billion of sales in 2022. That's about 2% of overall sales. And you look at the Wall Street reaction, I think the share's now higher by a percentage point following the open. The idea is this could improve cash flow. It's been a real struggle. Subscribers and audience there and growth there was a real question when it mattered to valuations in this sector. Subscribers kind of less important now. I think only with Netflix we're still kind of micro-focused on that as a metric. But the sell side at least saying this could improve cash flow, and it's very much in line with what Iger did when he came back, right, targeting that $5 billion of cost reduction and efficiencies to improve cash flow and the financial picture of Disney.
Ed, trying to stay across a lot of stories, let's just pick out this one, just briefly if you can. Neil Kashkari of the Federal Reserve has put out a blog, as he often does. He usually draws our attention to that on Twitter. He says this morning: please see threads, Neil Kashkari, for my new monetary policy essay on inflation and financial stability. So indeed we will shift across the threads and find that. But Ed, there's some signal there, not because it's Neil Kashkari, because that's kind of insignificant in the grand scheme of things. But Ed, what is happening with that platform war right now?
Yeah, it's really interesting because it's not unique to that particular Fed policymaker. You know, Sundar Pichai, the CEO of Alphabet, has also introduced himself on the Threads platform. RJ Scaringe, the Rivian CEO, has been very quiet on Twitter for quite a long time, but has now kind of gone to Threads and started posting there. We're seeing that. Executives, and also really interesting quickly, John, a lot of those executives are gaining a following even as large or larger than Mark Zuckerberg himself, who I've not yet seen arrive at Sun Valley.
Interesting. Ed, thank you, sir. Looking forward to your coverage through today. Looking forward to the program a little bit later as well with Caroline Hyde. Bloomberg Technology kicking off in about 2 hours and 20 minutes from now. This is the latest price action at the moment. The S&P up by 0.9%. Following that economic data about an hour ago, we do have a statement from the President of the United States, who incidentally is speaking right now alongside the likes of other NATO members as well. I think speaking to Zelensky at the moment over in Lithuania. This is a statement from the President on the June Consumer Price Index. Good jobs, lower costs, Bidenomics in action. Anne-Marie, AMH, in Lithuania, about 10 minutes away. Look out for that. Recent economic data highlighting some resiliency in US consumers, fueling upside in travel and leisure stocks, with the airlines and cruise lines outperforming so far this year. Chris Harvey of Wells Fargo saying economic fears are getting pushed back.
We still like growth. We still like GARP. We like mid-cap GARP. We like media and entertainment. So that hasn't changed so much. We do think the market's going to broaden out here, and it's really related to the perception. I mean, not so much that the economy's changed, but just the perception on the economy and the pushback of some of these economic fears.
Joining us now to discuss, Sarah Hunn of Alpine Saxon Woods. Sarah, I want to turn to the price action, and welcome to the program as always, that we've seen elsewhere in the airlines, in the cruise operators. The cruise operators year to date on the S&P 500, the performance is ridiculous. Carnival's up by something like 135%, 132 right now. Royal Caribbean up by 104%, Norwegian up by 82. Check out the airlines, it's up almost 50% across the board. United, American, Delta. Sarah, the data we've seen in the last week suggests that real incomes are starting to look better. Do you think the spending in this particular part of the economy can continue?
Well, if you think about where some of these stocks have come from, I mean, when we had the problems of the pandemic, and most of these companies, in many cases, especially on the cruise lines, had to raise a lot of money very quickly, and their equities went down in very, very large amounts from where they had started. It is very good to see that rebound, and you're seeing it in the activity because people, in fact, are traveling and doing a lot more than they were able to do for a couple of years. The question is, how long will that extend, and can they continue to raise prices? And I think that's what's going to be the biggest issue for the consumer going forward is we've had a huge amount of ability to raise price by a lot of these companies, and will they be able to keep it up? And you look at ticket prices for both cruises and for airlines, and you have to wonder whether or not that can be sustained.
There is some excitement this morning, Sarah. I'm sure you've heard it already in the last hour, that these conditions can persist. Positive real wage growth, the labour market can remain tight, inflation can remain subdued in and around 2-3%. Is that good for risk?
That happens, it's very good for is that really sustainable? And I think that the issue with the labor market is you saw real wages go higher and you saw the work week go higher. Those things are going to be more problematic from the Fed standpoint in terms of where they're expecting the labor markets to go. And they would like to see a little bit more weakness in the labor market, whether or not anybody wants to say that out loud. So the question really is, can you continue to have strong labor and strong wage growth without having an impact on margins and corporate earnings? And that, I think, is where you're going to start to see some tension coming through towards the end of the year. What does that really look like, and what does that look like for margins? That's going to be an issue on the earnings front, and that is also going to be a little bit, could be problematic for risk. It doesn't have to be. It depends, again, on whether or not you have a benign cycle where I can keep raising prices because wages are going higher, but I don't have as much inflation. I think that's a little bit of a tricky one to navigate, but we'll see how that happens going forward.
Sarah, that labour cost issue, do you think that's a sector story, or is it a story within sector? Do you expect to see some dispersion within companies within certain sectors?
I think there will definitely be some dispersion, but at the end of the day, if you don't have that participation rate go back to where it was pre-pandemic, you're going to have less labor in the market, which means that across the board wages are going to have to be higher. You're already looking at companies, the earlier story about Chipotle, looking towards more automation. You're going to see that happening because companies are now being pushed by labor costs, and they're looking to do things. So I think that is more an across-the-board story than a specific sector story. But as any sector gets weaker, you'll see wages in that sector weaker. The idea that we possibly have had sort of a rolling recession where one sector goes in and one sector comes out may be one of the reasons that the economy has looked so resilient.
We've discussed service sector winners, cruise lines, airlines. Let's talk about losers. Banks, tough year. Sarah, almost across the board. I talked about that downgrade, whatever that's worth, from Citi on JP Morgan to neutral going into Friday. We might get excited this morning about where inflation data is trending, where jobs growth is and has been over the last year. There is a belief that on Friday we're going to be very focused on credit quality, very focused on loan loss reserves. Sarah, is that your focus too?
I think there's absolutely a reason to be checking in with what's going on with the consumer, and you've already started to see some cracks in that with delinquencies going a bit higher and companies taking larger loan reserves. I think that is one of those issues that is going to be, right now we're feeling some relief on the inflation front because of this data print, but I think as we go forward, we're really going to have to analyze what's happening with the consumer and what's happening with companies, both on the top line and on the margin line. And I think for banks, it is a very tough environment because you still have that inverted yield curve. That hasn't gone away. And I think that there are some real issues in the ability to earn money for them and the question of whether or not you're going to start to see a little bit of a weaker consumer come through on the charge-off side. So I think that there is a lot of data to focus on once we get past the CPI print, and I think there's going to be a lot of scrutiny of earnings into Q2 about what's been going on for the last quarter, because some of this CPI data is also a little bit behind. So we were talking about the owner equivalent rents, whether or not housing has gotten more expensive. I would say, as a Northeast bias, it certainly has.
Sarah, one final word on a sector you've liked but hasn't performed in the way I'm sure you would have hoped it would. Energy. What's going on?
Well, I think that the hope that rates will come down is going to be better for energy stocks because part of the issue has been higher rates, and that has been also impacting the oil price. But you've also seen a lot of supply, and you've seen a lot more supply than people expected. If the economy is going to be on a better trajectory than people had feared a few months ago, energy should start to pick up, and you're seeing prices come up a little bit higher today on that CPI print. But I think that longer term, that lack of investment is going to come through, and you will see higher and more sustainable energy costs or energy prices. You've also seen some of those stocks on the natural gas front and the LNG front start to perform much better. So we think that trend can continue.
Sarah Hunt, thank you. From Alpine Saxon Woods, Morgan Stanley just a moment ago publishing, this is what they've got to say. This month's low-core print won't stop the Fed from hiking in July. Ellen Zeller and the team previously stating they think we're going to hike in July. We won't meet the bar for a hike in September. 1 hour, 15 minutes ago, that inflation data changed the debate this week, at least a little bit. Equities up by 0.9% on the S&P, on the Nasdaq higher by a little more than 1%. Coming up next, President Biden preps for a NATO victory lap.
We just concluded the first meeting of the NATO-Ukraine Council, and all our allies agreed Ukraine's future lies in NATO. Allies all agreed to lift the requirements for membership action plan for Ukraine and to create a path to NATO membership while Ukraine continues to make progress on necessary reforms.
President Biden moments ago in Lithuania, that conversation with Maria Tadeo, coming up next.
We just concluded the first meeting of the NATO-Ukraine Council, and all our allies agreed Ukraine's future lies in NATO. Allies all agreed to lift the requirements for membership action plan for Ukraine and to create a path to NATO membership while Ukraine continues to make progress on necessary reforms.
President Biden, moments ago, as NATO members make progress on aid and security guarantees for Ukraine. President Biden likely to frame the summit as a successful outcome of his global engagement. Biden set to speak this afternoon as that summit finishes. National Security Advisor Jake Sullivan said the president will highlight, quote, how the U.S. and our allies are supporting Ukraine, defending democratic values, and taking action to address global challenges. Your team coverage starts right now. AMH alongside Bloomberg's Maria Tadeo. And Marie, first to you. A success for the president?
Well, it was a success in the sense that this is really part of his major foreign policy goal, not just keeping NATO united, but also the expansion of NATO. We had here Sweden joining, and then today you saw some reconciliation with Zelensky, who really took a sharp tone with NATO members yesterday. A success, or maybe there's been some questions regarding the optics because the president decided to skip a dinner last night. This is kind of par for the course for the president. I've been a number of these international trips with him, and he's missed some of the dinners, and it comes at a time when Jake Sullivan was asked about it, and he said, well, he didn't think he had to go because he was going to have deep engagement with these individuals at the summit, and he has been having this engagement with them since Russia invaded Ukraine. But the issue is, Jonathan, of course, as the president tries to make this big foreign policy speech today really an argument for the American people to trust him, they're questioning a lot of things about Biden as a campaign candidate running for 2024, because poll after poll continues to show that Americans are nervous about his age.
We'll take that address a little bit later. Maria, if the president spins this as a success, do you think Zelensky would say the same thing?
Well, look, the question is, did Ukraine get everything they wanted? They did not. And of course, we should make it clear there was going to be no formal invitation for Ukraine. It's clear to everyone the country is at war. And it was clear from the beginning. Remember, the president was very clear on this. On the Sunday, you cannot get into direct confrontation with Russia as NATO. That would be incredibly dangerous for the world. The real issue here was the management of the expectations, maybe the mismanagement of the expectations. But I think today we have seen a real change in tone from President Zelensky. Yesterday, he put out that tweet where he said, a lot of the arguments that I hear are, quote, absurd. We've been here before. This morning, again, repeated, we have to be on the same page when it comes to the invitation. But now you see a Zelensky who says this was a good package for Ukraine. An invitation would have been the optimal outcome when it comes to the political signal. But the country walks away, as Anne-Marie said, with a G7 commitment, with funding, with training. And again, this political declaration that they can not join now. The conditions are not there, but the future of Ukraine is in NATO. Is it a perfect package for Ukraine? No, but I was told by a very senior European official, objectively, you cannot say this was a bad meeting for President Zelensky.
That address by the President of the United States, 12:45 Eastern Time. We'll take some of that coverage for you right here on Bloomberg TV and, of course, on Bloomberg Radio. AMH, just on the dinner, just quickly, why don't they just say the food sucks? You know, would you eat at one of these things?
I think I would, Jonathan. When you go to these international summits, the head of state that organizes it, they put their best people forward to make sure they're making a great impression. So personally, I would eat at them. I'm not sure the president's staff, though, any president wants their principal eating at these events, though, just in case.
Interesting. AMH alongside Maria Tadeo. Thank you, guys. Appreciate it, as always. About 23 minutes into the session, equities on the S&P at 1 full percentage point. We're looking at a 3-day winning streak on the S&P 500. Your trading diary up next.
Top experts, great questions.
So far, so good this morning. Equities up for a third session at 1% on the S&P. That's the price action. Let's get to the trading diary. National Economic Council Director Lael Brainerd speaking at noon Eastern. Then the President delivering remarks from NATO, 12:45 this afternoon. More Fed speak later. Bostic, Mester, plus the Fed's Beige Book, 2 p.m. Eastern Time. US PPI and another round of jobless claims tomorrow morning. We round out the week with earnings from the big banks this Friday. Wells, Citi, JP Morgan. From New York, that is it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the training day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, July 12th. Here are the top market stories that we're following for you at this hour. Cooling down, U.S. inflation rising at the slowest pace in over 2 years. Core services ex-housing breaks below 4%. And heating up, yields drop as investors flood into the market to buy some duration. And going sideways, Goldman Sachs actively starting to downplay results next week. Analysts/estimates, the stock is down 6% in the last month. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets, and we just got the Bank of Canada decision out. What do we have, Guy?
Time to get a little loony. So the Bank of Canada raises by 25 bips. As anticipated, that certainly matches the estimates. In terms of what they see, though, going forward from here, Alex, they see at the Bank of Canada CPI returning to target 6 months later, i.e. in mid-2025. So it's going to take a while to get inflation back down to target. And I guess that question really applies to the U.S. as well. We're now at kind of 3%. How long does it take to get to 2%?
Yeah, and Jay Powell, in essence, kind of talked about that. That he's like, when he was in... where was he? In Europe? Just
he
there.
was at Sintra.
Thank you. Wow, that was rough. But he basically said that in Sintra, right? That we're not going to see return to target through next year at all. So this definitely kind of melds up with that. I guess the question is, are the lagged effects going to put the heat on the Bank of Canada to do more or less or stay?
Well, that's the big question. The rhetoric has been fairly hawkish, and that has been, again, similar to what we've seen from the Fed. And the real question is, if we start to get down towards 2%, if we go from 3 to 2, are we going to bounce off that? Once the base effects and all kinds of other aspects of this inflation print that we've been watching so carefully today drop out, are we going to be left with an inflation rate that is actually stabilizing north of 2% and then has the danger of accelerating north from it? And I think that's the risk at the moment. Is any position you put on still a trade, or can you start to bank on the fact that maybe we've seen cycle highs for things like the 10-year?
Yeah, exactly. And then, as you say, if we kind of peak there and if we stay there for a while, what does that look like? Like, is that a signal to then go take on duration risk, as we were sort of talking about in our editorial meeting?
Yep.
Or do you have to kind of just wait and see? I don't know.
It's a big question. Is it a trade? Can you lock in these kinds of rates right now? I know we're not at cycle highs, but can you lock them in and live off them for the next few years, potentially the next decade? That's our question of the day. Is it now the right time? Is it the moment to buy duration? Joining us now to discuss all of this is Bloomberg's Ira Jersey of Bloomberg Intelligence, our rate strategist, and from Idaho, Bloomberg's Mike McKee. Ira, let me start with you first of all. The bond market is looking at what we've got right now, trying to figure out where the data goes next, and wondering whether or not, for instance, for the 10-year, whether the cycle high is in. What do you think? Is now the moment to step in and buy that duration?
So yeah, so the 10-year and the long end of the curve, so looking out to the 30-year, we think has been range-bound and will continue to be range-bound. We kind of tested the top end of that range when 10-year yields got above 4%. But there's not a lot of reason for the long end to move right now, even with this little gyrations like, will the Fed go another 25 or another 50? Will they pause? That shouldn't matter that much to the long end of the curve. What the long end of the curve is pricing now is for the Federal Reserve to cut interest rates to some steady state level, probably 3%-ish, plus or minus a little bit. So if you think that the Fed ultimately is going to have to cut interest rates during the next recession sometime in the next 3 or 4 years, then 3.9% looks reasonably attractive given the potential for 3% short-term rates.
So Mike, same question to you. Is it time to buy duration, which is basically our question of asking you, hey, have we seen peak rates?
I don't think we can necessarily say we have seen the worst of it, but it's beginning to look that way. You'd want another month or two of the same kind of movements in order to be a little more certain about what's going to be happening. And the Fed is promising to raise rates at least one more time, I think. And so we're definitely not at the peak for rates. Then the question becomes, when do they cut? And as Ira correctly said, well, that could be in 3 or 4 years. We don't know. It's just going to depend on, at this point, how hard they feel they have to go to get that last mile, because they've gotten down to 3% on the headline and 4.8 on the core. They want to get to 2%. Do they need to keep rates where they are? Or will they feel they can cut them a little bit but still leave them elevated?
Mike, I was listening to Bill Dudley a little bit earlier on, and he was talking about this sort of base effect, this disinflationary base effect, which is in the system right now. We're seeing a whole bunch of things, particularly in the goods sector, coming down. There's a base effect that is kicking in, which is dragging us lower. There's a very kind of positive base effect bringing inflation lower. Is the Fed going to have to wait basically until the end of the year, until some of that's washed out, before it can be convinced that it's got inflation under control, before it is convinced that inflation isn't going to reaccelerate as we saw in the 1970s?
Well, I think that's what they're saying they're going to do because they want to make sure, they want to have enough data in hand. The bad news about base effects is, yes, inflation was very high last June, so we got a boost which lowered inflation a lot on a headline basis for this month, and that changes next month, and it'll be harder to make progress. But the good news in this report was there was a lot of month-over-month slower inflation, and if that continues, it will mitigate a little bit of the problem. The issue that we've had so far is that we get 1 month on, 1 month off. Someone described it as inflation whack-a-mole. And the Fed's going to want to see steady state declines rather than 1 month on and 1 month off.
Right, because as we learned, things can go up and down at the same time with that. So, Guy, this brings us to the question then, is it really how high, but again, how long? So as we wait for the gyrations to settle out, is it just going to be stay there and hold for quite a long time, particularly if the target now for 2% isn't going to be hit till 2025, for example?
Yeah, and I think so that comes down to the interesting question as to whether or not actually, if you buy duration now, is it a trade or is it something that you can lock in? And I think that's the key question that I'm trying to figure out and trying to understand at the moment. There is still this risk that we see inflation stay relatively elevated. There is still this risk that inflation accelerates to the upside at the back end of the year. So Ira, when am I going to know whether or not owning duration is a trade or something I can stick in my back pocket and keep it there?
Well, yeah, obviously, it's difficult to know that ex ante, but I guess it depends on what your goal ultimately is. So, you know, if you are willing to hold, say, a 5-year note for 5 years and, you know, make 4% or a little over 4%, then, you know, that's a reasonable return, and that gets your carry up there. And if you think about that vis-a-vis what we just got on inflation, look, with headline inflation somewhere, you know, 0.2% per month, if you think that that's going to persist, then you actually get a real return, right? So you look at what's being priced into the TIPS market at around a little under 2% in terms of real yields going forward. You know, that's carry that we haven't seen basically for over a decade. So it seems like, you know, that might not be unattractive to investors who just have some money to put away kind of in a rainy day fund.
The real question, though, Alex, is the Fed going to want to shift perception in that kind of 3 to 7 year area in order to kind of lock it? Does that area of the curve, does the belly of the curve need to come up to Fed funds rates? Or can it kind of stick where it is now? And I think that's the question. Ultimately, the market has continued to underprice the Fed on an ongoing basis. But at some point, maybe if the Fed is determined to stick at higher rates for longer, that portion of the curve needs to move.
Well, this also goes to the point of monetary transmission and sort of where you feel it. Like, yes, there is some from the front end, but then the long end is maybe where you need to get that curve up and the curve steepening in order to really transmit to the real economy, Mike. There was some nice articles out over the weekend that talked about this, that we need some active QT in the market to really wind up pushing yields in the long end higher in order for the inflation to come down faster.
Well, that should continue to happen if the news continues to come in as it has on the other side, on the demand side. We've seen still very strong job numbers. Interestingly, I had a conversation with a couple of CEOs out here last night who were saying it's still very hard for them to find employees, and they are still having to pay more. So while business is really good, they said, their costs are still up. So if the whole thing continues as it has, you should see 10s try to find a new higher level. But I would leave it to Ira to predict more closely where they will end up. And I think right now it's really hard to know, because while we got good news today on inflation, we also had strong job growth. And you know, what is this economy really telling us?
That is a great question. We'll get into that too. All right, guys, thanks a lot. Really appreciate Michael McKee and Ira Jersey of Bloomberg Intelligence. Thank you very much. Just updating you on some headlines here. We have a bilateral meeting underway between President Biden and Ukraine's President Zelensky in Vilnius. You're looking at live shots right there. President Biden saying that Ukraine and NATO is going to happen, saying that they're doing everything that we can to get what Ukraine needs. And he also acknowledges that Zelensky can be frustrated and that is very justified. So we're looking at live shots of the bilateral meeting between President Biden and President Zelensky. We'll update you on those headlines as more come out. All right, coming up is more on our question of the day. Is it time to buy duration? And as the guy points out, is it a trade or a long-term call? Callie Cox of U.S. investment analyst at eToro is up next. This is Bloomberg.
Earnings season is coming.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Those who have tried to hedge, those who have tried to position for this downside, in the last 2 to 3 years, Alex, they've just been completely burned. You know, my joke to investors is, hey, what's been the best option strategy year to date? It hasn't been. It's been just being long the S&P. Every single option strategy, unfortunately, has underperformed just being long the S&P.
That was Amy Silverman of RBC Capital Markets talking to Guy and I yesterday, and that brings us to the question of the day. Is it time to buy duration if we're going to see inflation roll over and if rates have actually peaked? Joining us now is Callie Cox, U.S. investment analyst at eToro. Callie, what do you think?
Ooh, well, it's a good question to start off, and I like what Ira Jersey said about it being a trade versus an investment, because that's an important distinction here. It always is, and if it's a trade, I would say probably not, especially when economic data still looks really strong and inflation isn't quite back down to 2% yet. But as an investment, and we've been saying this for months now, it may be smart to start looking at those longer term assets because they are a little bit cheaper. They got hammered really hard in 2022. And at least for bonds, if you're looking at more conservative, longer dated assets, they could be a good hedge if we do end up hitting a recession.
Callie, Simon Weiss and I were knocking this around as well a little bit earlier on the MLive team, trying to understand what is happening here. And I guess it comes down to whether or not you think the Fed ultimately will be able to get inflation down to 2% and get it to stay there. Do you think inflation is beat at this point? Do you think it's going to come back to target? Or do you think we're going to be living for higher inflation for a little bit longer?
Yeah, I would say probably don't take the W yet on this. I'm not willing to take the W until we see inflation, core PCE back at 2%, because it really does feel like we're walking a tightrope here. But at the same time, I think we can celebrate the fact that inflation has slowed for 12 straight months here. I mean, it looks like the Fed is threading the needle for now, but we also have to remember that inflation is slowing conceivably because demand is slowing too. So I think it's really going to have to grind down to the wire.
Which hence sort of going by the long end now, why not? Sit there a little bit and then get the coupon. Does that translate into long duration equity assets?
Yes. So I think you have to think about equities, obviously, a little bit different than bonds here. In bonds, we're thinking more conservative if you're looking long duration, because if you're thinking longer term, I mean, the fact is we are in a tenuous economic environment here. I mean, the trend is pretty clear. So if you're thinking longer term, you have to think about what investments could make it through a recession, what companies could make it through a recession. So we like longer duration assets, especially in the stock market, but I think you have to look at that quality risk. Those companies that are profitable can fund themselves, do have those big cash hoards and strong balance sheet moats.
Yeah. Aren't those kind of stocks, and I'm assuming we're talking about tech here, Callie, aren't those stocks super expensive? Aren't stocks in general super expensive right now?
So they are expensive relative to bond yields. I'm looking a little less at valuations at the moment because if we are in the beginning of a bull market here, valuations tend to lead fundamentals. So, if you believe earnings could catch up over the following 12 to 24 months like we do, then the market could look a little bit cheaper. And a lot of investors do look over 5 to 10 years. I mean, of course, time frame is everything in this business. But, if you're looking over the next 5 to 10 years, then I'd say, maybe the stock market doesn't look so expensive after all.
Yeah, Guy, I was talking to Bloomberg Intelligence about this too, that it's definitely a show me story when it comes to tech, but like we've already priced that in, but now they actually have to deliver. And Guy, I guess it also goes to the point of like, well, then if inflation has peaked and we are rolling over, but it's going to be a little bit of a bumpy ride, what does that wind up meaning for margins? Like if demand's falling off, that's bad for the top end, but if prices are coming down, maybe margins hold up?
Maybe, and I think we're going to be looking for evidence of that on these earnings calls. But Callie's talking about the idea that we're potentially going into a bull market. And as you say, there's a lot of imponderables around earnings at this point, around margins that are really difficult to kind of fathom at the moment. Is that the kind of genesis of a bull market? I don't know. And also, we're going into a bull market, this is the start of one, with very high valuations versus historic norms. Callie, can we start a bull market with valuations at these kinds of levels?
Yeah, so look, this is an awkward bull market, but I think it's a bull market until proven otherwise. There are some tensions, and there normally are at the start of bull markets, right? Like things don't feel great, but they ultimately settle out in the next 12 months or so. I think technically the trend is very, very strong. And, you know, if we are going to avoid that recession and the Fed really does have inflation under control, then I find it hard to argue that we're not in a bull market. And then, you know, valuations or fundamentals end up catching up to valuations and things don't look so crazy. But it all depends on that push and pull between the Fed and inflation here. And the Fed still needs to pull this off.
Well, and then and to your point, I was looking at some of the stats today, right? Like 80% of the Russell 1000 is trading above its 50-day. You know, gold is testing the 100-day. WTI moving higher. Brent above 80 for the first time in May. This all does feel very bullish. In that mindset, what do you do with cyclicals?
Cyclicals, you have to think back to the economic trend here. I mean, cyclicals, when you're comparing them against those longer-term assets that, you know, might be more rate sensitive, then I think cyclicals look a little less attractive because the Fed has the economy in a vice right now. Growth is slowing, and by intention, growth is slowing. So right now, we're a little less optimistic about cyclicals. We'd say probably, you know, cut down your exposure there just a little bit, and then think about a barbell here. Think about that quality risk while, you know, staying defensive on the other end.
Yeah, memes at one end, defensive at the other. Some people may be pushing that strategy. Callie, great to see you. Thanks very much indeed. Thanks for joining us. Callie Cox of eToro. Still ahead, U.S. Commerce Secretary Gina Raimondo joining big tech executives in Sun Valley. The focus, of course, the CHIPS Act. More on that next. We are going to Sun Valley. This is Bloomberg.
It is 22 past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow from Sun Valley, Idaho. That view is so spectacular. You get all the awesome assignments. You also broke a nice story about U.S. Commerce Secretary Gina Raimondo arriving Tuesday and taking some meetings with high-level tech execs. What are you noticing?
Yeah, so the Commerce Secretary did arrive. We saw her, and I'm sure our audience will see pictures of her in just a moment. But what I'm told is that while she's here, she's going to take meetings with people on the sidelines of Sun Valley with two kind of big ticket items on the agenda. The first is the CHIPS Act, and the second is the US Indo-Pacific trade deal, which Bloomberg's reported quite recently. The tech industry has kind of come in for criticism because they've been trying to influence the makeup or criteria within the US's negotiations with countries like Australia in that region. So it was interesting to see that, and also just interesting to see a government official here at the Allen & Co conference.
Yeah. Why do these tech execs need convincing on the CHIPS Act? What does she need to do? What kind of a job does she need to do here?
Yeah, it's really interesting, and I think it's really important to be honest. I don't know, what her agenda or her goal is in doing that. There are interesting people here. An example being Tim Cook, the CEO of Apple, who arrived last night. We are not reporting that Gina Raimondo is meeting with Tim Cook. We do not know that. But think back to what happened in November and the reporting around Apple's in-house efforts with its chip. We know that they are planning actively to source their in-house chips from a fab in Arizona that TSMC is building. And so much of the supply chain for Apple is under scrutiny at the moment in China. What are they doing to India? But when it comes to semiconductors, there is just this massive effort from the Biden administration to have tech giants onshore where they're sourcing their chips from in the future.
Can I switch gears for a second to talk about Disney, because the media part, we got to hit that. So there were reports that potentially they might sell their India TV business, and the stock was up a little bit on that. The stock is up about 0.8%. What are you hearing on the ground?
Yeah, I mean, Mr. Iger, the CEO of Disney, walked past last night. I, tried to ask him about the reports on the Disney divestment idea, and he wasn't too keen to talk about it. He said, "I don't have anything interesting to talk about." But the idea is that Disney Star or Hotstar. Yeah, no, a smile is worth a lot. But Disney Star, Disney Hotstar. According to sources, they could sell it off. They could, they could reduce the stake in it. It was $1.7 billion of sales last year, 2% of total revenue, which isn't huge. In a country like India with so many potential subscribers, it just didn't really gain traction. We talked a lot, the three of us, in the past about the pricing power or lack of for Disney in that market. It's a different economy. Median household income is completely different, so they can't raise prices. They lost the rights to show the cricket, and I think that's been a really big deal, a big catalyst for them to thinking about improving cash flow as part of the broader Iger turnaround plan and doing something to get rid of that asset.
After three Ashes tests, I'd be quite happy to lose the right to watch the cricket as well. Though some optimism going into the fourth test. Ed, that probably feels like a long way away for you. Ed Ludlow. You can catch Ed Ludlow and Caroline Hyde on Bloomberg Technology. That's coming up in around 90 minutes' time. Apparently airfares are falling. Apparently they fell 8% in June. Our next guest says that he expects travel to be soft again in July. So U.S. inflation is cooling. It is now cooling to the slowest pace in more than 2 years. We've had a lot of 0.4s, we've had a lot of 0.5s, we've had a few 0.3s, now we're getting 0.2s. Does that slow further? We've got a July hike looking like it is pretty much baked in, but where do we go after that? And if inflation is now at a point where we think the Fed can back off, do you want to buy duration, i.e. can you start to lock in some of these higher rates that we have now? Trying to get some insights on all of this is absolutely critical. It's the perfect person to talk to, and that is Omer Sharif, Inflation Insights President and Founder. He joins us now. Omer, okay, so we've had a whole bunch of 0.3s, we've had a whole bunch of 0.4s, we've had a whole bunch of 0.5s. Now we're getting 0.2s. How many 0.2s are we going to get, and how many more do you think the Fed needs to see before it thinks it's got things under control?
Hi, Guy. Yeah, so I think I would start with what Chair Powell said last year, which was when we had this conversation about what the Fed needed to see, he kept mentioning that they wanted to see a string of lower readings. So obviously this is not going to do it, but my guess is that we're going to see 0.2s with possibly even a 0.1 on the core coming up as well in the July, August, and September reports. Mm-hmm. So if we think about that August report that's coming up a little bit before the meeting, so at that point I think they'll have 3 readings that'll be 0.2 or possibly even a bit below, which is why I think that September hike is one where they could afford to skip again, given the way inflation's sort of behaving right now.
Hey, Omer, how much of that is going to be housing? If 70% of the rise in CPI was due to housing, is that what's going to roll over to get those prints you're talking about?
Well, that's certainly part of it. I mean, housing is contributing way, way less in the last, 3 months of prints than it was, let's say, in the back half of last year. That's going to keep decelerating to some extent. But really, to me, this was less about, shelter inflation than it was much more sort of broad-based disinflation. So Chair Powell talked about the super core, right? Core services excluding housing. That was 0 today. It was 0.2 last month. It was 0.1 the month before. So if you look, for example, I don't think these numbers are out just yet, but my suspicion is that when the Cleveland Fed data is released shortly, that 16% trim mean number is only going to be about a 0.2. The Atlanta Fed core sticky price index, excluding shelter, will probably be flat. So to me, this is much more broad-based than just a story about housing. Services inflation is finally sort of moderating at the rate that I think the Fed wants to see.
The Bank of Canada has just said it's going to take probably until 2025, a little longer than anticipated, 6 months longer, to get inflation back down to target. Given what we've seen today, when do you think the Fed is going to get inflation back down to target?
Yeah, so I think that depends on what measure you want to look at. The Fed, if you want to look at year-over-year rates, that is going to take some time. That probably, my suspicion is, won't be until later in the back half of 2024. However, I think, as I mentioned earlier, given what I expect will be a string of soft readings on the core over the summer, I think the run rate for the 3-month annualized rate, which is way more relevant in my mind than the year-over-year rate, I think that'll probably be down to something around 2.6 or 2.7.